Greg, good to chat with you again. I mean, what is that? What do you mean by the safety zone? Is there a safety zone right now?
I think there is, and I think we mentioned one of the sectors that's in the safety zone when we talked about NVIDIA and AMD. To me, the safety zone is the sectors and the companies that will show sustainable growth, that are experiencing a secular tailwind, that retrenchments and mandates and increased caution and spread of Omicron really won't affect it. And we saw those sectors perform in 2020. So I mean by that sectors like enterprise software, like the cloud, like semis, especially those levered to the data center, as NVIDIA and as AMD are. Secondly, when you find those sectors and companies with secular tailwinds, what it largely means is that they are somewhat insulated from the inflationary pressures we've been seeing and that I expect to continue to grow into next quarter. Be that because they have pricing power or because they just aren't hiring at the levels where we're seeing the wage pressure, or because they don't have those component needs from other enterprises, so they're not subject to the cost inflation. So we're looking for secular tailwinds. We're looking for growth that is sustainable, whatever the macro is going to bring us. We're looking for insulation from the inflationary pressures, and we're looking for pricing power.
Yeah, you're looking for a lot, but with some of these names, everybody we talk to says, yeah, they've got it. They're going to have it. They're going to continue to have it next year. Let's talk about something else. We talk about bond yields all the time on CNBC. I'm willing to bet that the majority of our viewers and listeners do not trade bonds for a living. They might care about mortgage rates, of course, or car, whatever they're borrowing money, the rates are. But you know who really cares about bond yields? Banks. And actually, higher yields are generally pretty good for some of the biggest banks. You're bullish on the banks. Couldn't they do well even if yields don't rise that much?
I do think that they can, or at least some of them can. You know, back when we first started talking about this a year and a half ago, it was a different trade. They were trading at what I would call catastrophe multiples. Now the multiples have normalized, but we've seen that we can continue to get performance through growth drivers in the business. Those growth drivers year to date have been the capital markets, the advisory fees, the trading, the institutional side of the business. And only some of the banks have that, right? We're talking about the large conglomerates like JP Morgan, Bank of America, Morgan Stanley, Goldman. The other real key growth driver for the banks is the net interest margin environment. And obviously that's more advantageous when rates are rising. And so I think what we'll hear when we hear from them in January, and luckily for us, you know, they're some of the first to report, but I think they'll be downright giddy about the prospect of a more advantageous net interest margin and having their other growth driver. And so they can perform not on multiple expansion, but on earnings growth.
Another sector that's had some giddy executives, at least recently, have been big tech. I know that was another one of your big safety plays, but there are certain market commentators out there that are concerned about the narrowing breadth that's been driving the rally higher, namely the fact that it's really been driven by 5 big tech stocks. Does that concern you? Do you still see that as a safety play, given some of the divergence between large cap tech and some of the smaller cap names?
Normally it would. Normally we'd like to see wider breadth and we'd like to see wider participation to have some certainty in that base in the market. Here it actually doesn't. And in fact, I'm probably a big advocate in narrowing my own breadth because at the end of the day, there will be sectors and there will be companies that will be more highly impacted by inflationary pressures, more highly impacted by a retrenchment for closures as Omicron threatens the health system. The severity is not as important as the actual transmissibility and immune elusiveness, because as soon as the healthcare system starts to be on the brink of collapse, we're going to see more retrenchments. And that's just going to affect some sectors more than others. And so even if you have a long-term perspective, I'm going to stay away from those sectors that I believe will be more highly impacted and that we can get cheaper afterwards.
Interesting. Well, we'll see what 2022 brings. Greg Branch, thank you very much for joining us today.
Always my pleasure.